Going ghost on investors. So I guess ghost is a verb now for that. All right, startups typically depend on serial infusions of funding from backers to get through their early years, and a so-called down round that's raising money at a lower implied valuation than before is a big black eye. So lately, companies have gotten very creative to try and avoid being considered less valuable. Joining us now is Hema Parmar, who wrote the story for Business Week, as well as Ken Smythe, managing partner over at Next Round Capital, who's quoted in the piece and remains giving me a thumbs up because I said both names correctly, which was not a given 5 seconds ago. All right, Hema, when you wrote this piece, what did you find out? Because managing this is really important for startups.
Precisely. And in this market where everything has gotten a lot more challenging, people are very concerned about valuations. And companies are concerned about a potential down round or being viewed as less valuable in a tricky market. It can impact their future fundraising, it can impact IPOs. And so some of the things that we're seeing they're doing to avoid potentially being viewed as worth less, ghosting investors, not sharing information with them, impacting the secondary market, blocking secondary transactions, all these kinds of methods to sort of keep their viewpoint and their perspective of investors higher.
Ken, that can't be cool.
No, it's not.
Right, so then where's the visibility?
So CEOs are really just hoping that, this all goes away one day and that they can cling on as much as they can to 2021 valuations, which as we call is the high watermark. We're unfortunately a lot lower than that. And so the difference that we're seeing is that 2021 high watermark and people fighting to sort of find balance of what true valuations are. But the challenge, as Hema said, is how do you know the true financial performance of these businesses if they're not giving it to you and they're only giving selective disclosure? So this is how Sarbanes-Oxley got started in the public markets. Some investors got certain information, others investors didn't. In the private market, it happens every day, right? So you have a wide disparity of valuations and prices of where these companies are trading, and if the CEO and the board doesn't like it, they don't allow it.
Okay, so there's an issue of the opaqueness of what's going on, not only in terms of the performance, but also the story points out that there are workarounds to sell off shares in a way that wouldn't be made public, or at least not be made privy for the folks who would have a stake, or at least have some interest in knowing that that was done.
Correct.
How do you do that?
And so you basically, it's a workaround, right? It's called the gray market, right? And this is where you try to keep these transactions away from company management, the board, and you as an LP will say to another LP, hey, I'll create a new LLC structure. You can own the LLC structure and buy it. And, it's just our deal, right?
How much of this, though, is being spurred from internally by those companies, and how much of it is from the outside pressure by investors and LPs? I mean, there are a lot of folks who have raised a lot of questions in this recent cycle about the returns that were promised and the returns that they have not yet gotten.
That's right. So we're in an environment right now where this business, venture capital, was $27 billion of invested capital in 2012. Currently, as of last year, we're at $345 billion. So massive growth. The number of unicorns went from 9 in 2012 to 345 today. So you can understand this is now what used to be 10, 12 years ago, really kind of a small little cottage industry, has now grown into a massive amount of companies that are now having to abide by standards that were set many, many years ago, right? And so basically the growth of the market hasn't kept pace. And so LPs are upset. Right? They want what they call DPI, which is basically a return of their cash. Yeah. They were told 8, 9, 10 years ago, by 2024, like, when the Jetsons were flying around, when the Jetsons are going to be flying around, you're going to have your money back with a 2 to 3x return. Yeah. Well, many of those Fund 1 and Fund 2 still haven't given $1 back. Yeah. And so with an IPO market that's been slow, M&A market that's been very tepid, you only have one option, is you can sell in the secondary market, or you continue to wait till venture capital markets tell you what they're worth.
Hema, if the Fed cuts rates, does this all go away?
I mean, it's going to take time because companies are dealing with cash flow issues. They're dealing with debt they have to pay off. It's going to be a little while, and some of them still haven't been marked down by investors nearly as much as they may need to be. So there is this lag between public markets and private markets, and you see that in sometimes 18 months delay. So things will probably get better as rates come down, but it's going to take some time, I think.
And in addition to that, only have about 30 seconds left. Does a healthier IPO market, does that absolve some of this?
It does and it doesn't. It actually, this is where CEOs are really trying to guide the valuation, because as you start talking to bankers, they start paying attention to where actual transactions are happening, right? So the least or the lesser data they have pointing to a lower valuation, they can turn around and tell their bankers, hey, we've got stock that's trading at a premium or close to our valuation. That's where our IPO should go out. But the public markets are always going to determine what these companies are worth. So they're going to have their day in the sun at some point. It just doesn't happen in the private markets.